empire fights two wars at once. One is the war that you can see. That's the missiles, the carrier groups, the maps on cable news. The other is the war that you can't see, the one fought in bond auctions and currency markets. The quiet panic of finance ministers who suddenly stop sleeping. America is fighting both right now, and the one that nobody's watching, that's the one that matters way more. But before we get into it, if you're new here, welcome. This channel exists for one reason, to cut through the noise and show you what's actually moving the global economy beneath the headlines. Hit subscribe and turn on notifications because what we're about to walk through is the kind of analysis you won't find on cable news. Now stay with me. 5 weeks into the US-Israeli campaign against Iran, here is what we know. The Strait of Hormuz, the 21-mile-wide corridor through which roughly one-fifth of the world's oil supply flows on any given day, is effectively closed. Tanker traffic has collapsed from a normal range of 60 to 70 transits per day to near zero. Iran's parliament speaker has said publicly that the strait will not return to its pre-war status, and quite frankly, I believe him. The International Energy Agency has called this the greatest global energy security threat in world history, and the consequences are spreading like cracks in a windshield. Qatar's Ras Laffan complex, the largest liquefied natural gas plant on Earth, responsible for supplying fuel to dozens of countries, has suffered massive missile damage. 17% of Qatar's entire LNG export capacity is knocked out for up to 5 years, best case scenario. Countries like Taiwan, which rely on liquefied natural gas for up to 40% of their electricity, have an 11-day stockpile. Australia has lowered its diesel quality standards and watched hundreds of petrol stations run completely dry. Slovenia became the first EU state to introduce fuel rationing. South Korea is enforcing a 5-day vehicle rotation system and moving to 4-day work weeks for government officials. So we know all of that. Here's the part that nobody is talking about. While the whole world watches the missiles and the carrier groups in the Persian Gulf, there is a second war happening, one that could break the entire American financial system. And to understand why there may be no good way out, you need to understand this other war as well. Michael Hague, the global head of commodities research at Societe Generale, one of the largest banks in Europe, said last week that the final vessels carrying jet fuel to the United Kingdom were arriving and that there is no more after that. Let that sink in. No more jet fuel arriving in the United Kingdom. And it's not just fuel. Dow Chemical, one of the largest chemical companies in the world, whose products end up in everything from food packaging to medical supplies, doubled their polyethylene price overnight. Now, why does that matter? It matters because polyethylene is in your grocery bags, your water bottles, your food packaging, and your medical equipment. If you bought it at a store, there's a good chance it touched polyethylene before it touched your hands. Polyethylene is made from petroleum-based feedstocks. When Hormuz closed, about 50% of global polyethylene supply vanished. When the price of energy goes up, the price of everything goes up. And you could say the same thing about polyethylene. This is how a war in the Middle East shows up at your grocery store. Energy doesn't stay in the energy sector. It flows through everything you buy, everything you eat, and everything you build. Now here's the military picture. American and Israeli interceptor stockpiles are running dangerously low. The Royal United Services Institute estimates that America is roughly a month from exhausting key missile defense systems, and it could take 5 years to rebuild what was expended in the first 16 days of this war. 13 American military bases in the region are now deemed all but uninhabitable, and not because they're destroyed, but because they're indefensible against an onslaught of 20 to 30 missiles and drones per day. A steady grinding pace that has confounded every analyst who expected Iran to run out weeks ago. Now, despite what you may have read about the ambiguous and disputed ceasefire, none of what I just said has changed. The Iranians have, by most honest assessments, locked the United States out of the Middle East. Not because they have a better military, because they don't need one. Cheap missiles, cheap drones, and Russian satellite targeting have shown, for the first time in modern naval history, that a relatively inexpensive arsenal can deny the world's most powerful navy access to a critical waterway. For 400 years, since the days of the Dutch Empire, control of the seas has been the foundation of global power. The idea that a navy could be neutralized by a country with a fraction of America's military budget was, until 5 weeks ago, considered impossible by most defense analysts. That assumption is now dead. So, yes, everybody is watching Iran. Every headline, every missile strike, every presidential post about productive conversations that Tehran immediately denies. But that is only half the story. To understand the second war, the one that may matter more, you need to understand something that most people never think about. It's not complicated, but it is important. When the US government spends more money than it collects in taxes, which it does every single year to the tune of trillions of dollars, it borrows the difference. It does this by selling IOUs called treasury bonds. A 10-year treasury is simply a promise from the US government to pay you back in 10 years with interest. These bonds are considered the safest investment in the world because, in theory, the US government always pays its debts. Here's why that matters. Right now, countries around the world, Japan, the UK, China, South Korea, and dozens of others, hold roughly $9.4 trillion worth of these American IOUs. They bought them because treasuries are safe, they're liquid, and they're denominated in US dollars. For decades, this system has worked beautifully. The US borrows cheaply. Foreign governments park their savings in a safe asset. Everybody wins until everybody needs their cash back at the exact same time. Let me ask you a question. If you were running Japan's central bank and your country was suddenly staring down an energy crisis that threatened to shut down every factory, every power plant, and every shipping route, and you needed dollars immediately to buy oil on the open market, what would you sell first? You would sell the most liquid dollar-denominated asset that you own. You would sell US Treasuries. And that is exactly what's happening. Foreign central banks holding treasuries at the New York Federal Reserve have dropped to their lowest level since 2012. This decline started the month the war began. Countries that are short on energy and panicking are dumping American government bonds to raise dollars to pay for fuel. Japan holds $1.2 trillion in treasuries. The United Kingdom holds $895 billion. These are not small positions. Let me break this down clearly because although everybody talks about the treasury market, many people don't fully understand how it works. Put yourself in the position of the US government. You spend more than you make, so you need to borrow cash to pay your bills. Let's say I loan you $1,000 and you agree to pay me 5% interest, $50 a year for 5 years. I'm earning annual interest and I'll get my $1,000 back at the end. Sounds like a reasonable deal. But 2 years in, I get a cash call and I need my money back right now. The problem is you don't owe me the full amount back for another 3 years. So I go looking for someone to buy the loan from me. I find a third party and I tell them, look, this person owes me $1,000. They're paying 5% per year. The full amount is due in 3 years, but I need the cash today. So buy this loan from me and those payments are yours. The problem is that third party can smell my desperation. They know I need the money today. So they tell me they'll buy the loan, but not at full value. They'll pay me $800 for that $1,000 note. I'm not getting full value, but I am getting the cash today, which is what I need. So I take the deal. Now, think about what just happened. That third party paid $800 for a note that will pay them $1,000 in 3 years plus interest along the way. Their effective return, their yield, just went up because they paid less for the same stream of payments. Now imagine this happening at scale. Not one lender, but entire countries. Japan, the UK, South Korea, all desperate for cash to buy oil, all selling US Treasury bonds at the same time, all willing to take less than full value. And we're not talking thousands of dollars, we're talking trillions. So why is this a problem? Because the United States is still spending more than it earns and continues to need new loans. But if I can buy an existing treasury bond on the open market for $800, why would I pay the US government $1,000 for a brand new one? I wouldn't, and nobody would. So the government is forced to offer higher interest rates on its new bonds just to attract new lenders. This means the cost of borrowing goes up for the government itself at exactly the moment when it can least afford it. And because Treasury yields set the baseline for nearly every interest rate in the economy, suddenly mortgages, car loans, and corporate debt all get more expensive at once. This is the predicament. The United States needs to offer higher interest rates to incentivize other countries to lend it money, but higher interest rates will break its own economy. Here's what makes this really dangerous. Over the last 12 years, US federal debt has risen by a staggering $22 trillion. Over that same period, foreign buyers of that debt have been flat to declining. The gap has been filled increasingly by the Federal Reserve itself, America's central bank, essentially printing money to buy its own government's IOUs. That works when the world is calm and inflation is low. It doesn't work when oil is spiking, supply chains are fracturing, and the countries holding $9.4 trillion of your debt are selling it just to keep the lights on. This brings us to Scott Bessent, Trump's Treasury Secretary, the man responsible for making sure the US government can continue to borrow the money it needs to function. Every time the interest rate on the 10-year Treasury has crept toward 4.4% over the last 6 weeks, Trump has suddenly dialed back military action to calm the market. He pauses strikes, he extends deadlines, he posts about productive conversations. This is not a coincidence. 4.4% appears to be the line, the yield at which the cost of servicing America's $36 trillion national debt starts spiraling out of control. 3 consecutive Treasury auctions in late March, events where the government tries to sell new bonds to new investors, attracted very weak demand. In plain terms, that means the government put bonds up for sale and fewer people wanted to buy them. The 2-year and 5-year auctions were the weakest seen in years. The bond market is sending a message, and the message is, we don't trust that this ends well for the United States, and therefore, we don't trust US Treasuries. So what's the point of all this? The United States is not just fighting a war in the Strait of Hormuz, it's fighting a war in the bond market, and right now, the bond market is losing. Here's what a loss looks like. If Hormuz remains closed for another few weeks, which appears highly likely, the cost of oil stays at levels that guarantee a global recession, triggered by high energy costs, high polyethylene prices, high fertilizer costs, and high food prices. A recession means government tax revenues collapse because if fewer people are earning money, the government collects less of it. When revenues collapse but debt stays the same, interest payments eat an even larger share of the budget. That forces the government to borrow even more money at higher rates, which drives the debt higher, which drives rates higher still. Let me personalize this one more time. Imagine you spend more than you earn, so you borrow. Then you take a pay cut at work, so you must borrow more. But people are becoming wary of lending to you, so you have to offer a higher interest rate to get them interested. Now you're making higher interest payments every month, and you need money for that too. So you borrow even more again at that higher rate. You can see where this goes. And don't be fooled by the men in suits and the complex language from the podium. This is the exact situation the US government is in. Economists call this a debt spiral, and now you understand why. The logical question is this: if the bond market is really the threat, why not just leave Iran and focus on the financial crisis? Here's the reason. Because the two wars are actually the same war. You can't fix one without fixing the other. The bond market is under pressure because foreign central banks are selling treasuries. They're selling treasuries because they need dollars. They need dollars because oil prices have spiked. Oil prices have spiked because Hormuz is closed. And Hormuz is closed because the United States attacked Iran. Now, pull the thread in the other direction, and it unravels exactly the same way. If the United States walks away from Iran, Hormuz doesn't simply reopen on American terms. It reopens on Iran's terms, and this is not speculation. It's already happening. Iran is running a toll booth system in the Strait right now. Ships are paying passage in Chinese yuan and cryptocurrency. The IRGC is vetting vessels through its own clearance corridor. Chinese ships have sailed through. A French-owned container ship transited last week, likely paying in yuan since European banks won't process payments to a sanctioned state. As former British diplomat Alastair Crooke put it recently, Iran sees this conflict as an opportunity to change the entire geopolitics of West Asia. So if the US withdraws, the oil flows again, but not in dollars. The global energy trade shifts to Yuan settlement, routed through China's financial system. Deutsche Bank has already published a note calling the Iran war the potential catalyst for what they termed the making of the petro yuan. The dollar's reserve currency status, the very reason US Treasuries have been deemed the safest investment in the world and have allowed the United States to borrow $36 trillion and keep functioning, takes a hit it may never recover from. And so the bond market breaks anyway, just for a different reason. That is the quagmire. Not two doors, one good and one bad. Two doors, both bad. Stay in Iran, and the bond market bleeds from higher oil prices and foreign selling. Leave Iran, and the bond market bleeds from the death of the petrodollar and a collapse in global confidence. The only scenario where the Treasury market stabilizes is the one where the US regains control of the strait and oil flows again in US dollars through American secured waters on American terms. And that is why this war is not going to end quietly. Two wars. One you can see, the missiles, the drones, the carrier groups in the Gulf. One you can't, the bond auctions, the yield curve, and the slow motion panic spreading through central bank vaults from Tokyo to London. These are the same war. And right now, America is losing both of them. If this breakdown gave you something to think about, I'd genuinely like to know where you think it goes from here. Drop your take in the comments. And if you want more economic deep dives like this one every single week, subscribe right now. This is exactly the kind of analysis we do here, and I don't want you to miss what's coming next.